Hi, I'm Mark Anderson. I'm a nationwide mortgage banker with Paramount Bank. If you have questions about your mortgage, I have the best answers that you will find. For today's featured question, it comes from a client in St. Louis, Missouri, who is looking to purchase an investment property and is running into trouble with traditional mortgage programs. I want to purchase an investment property, but the mortgage broker that I'm working with took a look at my tax returns and said, absolutely not, no way, no how. This property is a heck of a deal. I would really like to add it to my portfolio. I need to figure out a way to make this investment purchase work. Can you help? So this is unfortunately a pretty common problem for self-employed people. If you are applying for a loan under the conventional standard guidelines, generally what you're looking at is Fannie Mae and Freddie Mac. The terms that you can get under these programs are almost always going to be better than what you can get outside of Fannie and Freddie. Now the problem, especially for self-employed people, is there's really just one method to calculate income for self-employed people through Fannie and Freddie, and there is a total reliance on the tax return. Now, there are some self-employed people that will artificially reduce the amount of income showing on their tax returns so they pay less in taxes. Now, those folks may shoot themselves in the foot when it comes time to apply for a mortgage, because if you're telling Uncle Sam you only earned this much and you need this much to qualify, well, therein could be a problem. But there are all sorts of other reasons that just based on the last 2 years of tax returns, that a business owner may not be able to fit into the Fannie Freddie box when it comes to income qualifying. If you are a business owner that, say, buys other businesses, maybe you reinvest a lot of your profits into the business or into other businesses. When we look at the most recent 2-year history, despite what your plans might be for the next 5 to 10 years, despite the great deal you got on this, that, or the other, and what it's going to be in the future, because we're hemmed into reviewing this 2-year window on your taxes, there are plenty of times where they simply do not have the documentation required under the guidelines to qualify for Fannie or Freddie. Now, fortunately, in the case of this client and many other people in the same boat, there are some alternative programs. Now, these alternative programs, they are not subprime programs. These are programs that are simply funded in different ways. They're not funded by Fannie. They're not funded by Freddie. They're funded a lot of times by private real estate investment trusts, by various private equity outfits and banks that are seeking to provide resources and options for folks that have been basically left behind by the big mortgage agencies. These lenders are taking much more risk. Now, they're also targeting market segments which may be riskier in general than your typical borrower that's going to go with that Fannie Mae, Freddie Mac, FHA type program. Because of that, the biggest trade-off that you get in exchange for the flexibility that these programs provide, the biggest trade-off is in the interest rate. Now, in the case of this client and other people in the same boat, I have 2 different programs that I'm generally going to look at, and I'm going to present these in order of what I would look at first and where I would go to if that first option doesn't work out. Sorry for the interruption, but my chickens were really wondering if you might just go ahead and tap that like button, and if you do, I'll let them out of the coop. The first option is called a bank statement program. So rather than look at this 2-year or 1-year window of the federal tax return, we're actually going to go very old school. We're going to do a cash flow analysis. And that cash flow analysis is supported with bank statements. Now, we might look at a period of 12 months, of 24 months. Most of the time, we're going to be looking specifically at the business bank statements, but some of these programs will allow us to kind of take a peek at the personal bank statements as well. And essentially what we're doing is we're going to look at all of the deposits over that 12 or 24-month period. Now, there's another side to this. There is no business on earth that's 100% profit. You've got overhead. You've got staffing expenses. There is something that we have to subtract from whatever the deposit total is over the window that we're looking at. There are many different ways to apply this expense analysis. Some programs take a flat percentage. They say whatever the inflows are, we're going to multiply those inflows by 50%. And the remaining total, whatever method is used to determine the expenses, the remaining total is what we use to plug into the mortgage application. With that income figure, the rest of the process is pretty traditional and very much like the way we would process a standard Fannie Mae or Freddie Mac loan. We're going to take that income figure and we're going to do a debt-to-income ratio analysis. The program is going to have certain criteria that says what our maximum debt-to-income ratio is and what is an approvable debt-to-income ratio versus one that is not. So the next option that I would consider for someone that cannot fit into the Fannie Freddie box, that can't fit into the bank statement loan, is we're going to look at a totally different type of program. It's called a debt service coverage ratio loan, or DSCR. Unlike the bank statement program, we are actually not going to calculate a debt-to-income ratio at all. A debt-to-income ratio calculation involves all of your income, all of your debts, including the new mortgage payment. What makes the DSCR program unique, and in this case potentially very beneficial for a borrower that needs it, is we're not going to concern ourselves with the global picture of all of your income, all of your debts. What we're going to look at is the exact property that you are purchasing. And we're going to take a close look at the rental value of that property. So what are the rents coming in? And are those rents coming in sufficiently high to cover the mortgage payment? So the calculation for a DSCR loan is actually fairly simple. What we're going to start with is we are going to get a market analysis of the rent on the property. And that's going to be done by the appraiser to tell us what the market rent value is of the property that you're purchasing. Whether it's a single family property, a duplex, a four family, we're going to have the appraiser do an analysis and tell us what each of those units is going to rent for. So we're going to start with that rental income calculation. We're going to take that total and we're going to divide it by the new total mortgage payment. Let's say it's a duplex. And each of the units, the appraiser says these units will rent for $750 a piece, so we have a total of $1,500. So on the top portion of our DSCR calculation, we're going to put in $1,500. Now, when we plug in the interest rate, the taxes, the insurance, we're going to do a calculation to determine the total mortgage payment. Let's say in this case it comes out to $1,300. So we're going to take $1,500 for the rent, and we're going to divide by the total mortgage payment of $1,300. And we get a total of 1.15. That is the critical number in a DSCR loan because, again, we're not doing a total cash flow analysis. We're just looking at this property in terms of how well are you doing on the property? How much in rent is coming in to offset the payment that you're taking on? And the determination as to whether or not you're approved depends totally on this DSCR number. Now, in the case of this example of 1.15, there are some programs where that actually would not be a high enough number. You would need something more like 1.25%. You need more cash flow, more positive cash flow in order to fit the program criteria. Now, there are some programs that may go as low as 1, as long as the rental income is enough to cover the payment. In this case, in this program, you may meet that approval criteria. Both in the case of the DSCR program and in the first program we talked about, the bank statement program, we've really just isolated down to the income portion of the review. There's a lot of other criteria that we do have to look at. And your actual individual terms and approval guidelines can vary on a lot of factors. The state where the property is located, the amount that you have available for down payment, your credit score, of course. There does need to be an overall review of your application, what you are bringing to the table as a borrower, in addition to the income piece that we've talked about today. But the most valuable thing about these programs is that it provides self-employed people options that are simply not available under the guidelines that we have from Fannie Mae and Freddie Mac. So if you are self-employed, and if like the client I talked to today, you're running into problems getting qualified under the traditional programs, these programs are very much worth considering. I would love to talk to you no matter where you are in the country. Give me a call, shoot me a text. We'll have a conversation, we'll go through the numbers, and we'll see if one of these programs might work for you. Thank you so much for watching the video. I look forward to talking to you soon. Thanks for the like. They're free.